Okay, welcome to this next masterclass, and the topic for this one is market efficiency, which should be quite a nice straightforward one, a bit of theory and then a bit of a practice that maybe impacts the ideal world that our theories were created in. So we need to understand what efficiency means in this context. Obviously, efficient is a word that gets used quite a lot in many contexts, so we need to make sure we're defining it properly in this context. And then ask ourselves, with this understanding of what efficiency is, how efficient is a market? Which is basically to do with how well and quickly it prices in information. And then can we be better than that market? Because if we can beat a market, we can rationally deduce which way share prices are going to move. We can get in there before they move, which is the ideal, isn't it, from an investor's perspective? So we start off with the theory, then we try and link it to real world markets from what we observe. And then we say, well, still some strange things happen in the world of prices. And can we explain that through the newer field, certainly newer compared to the traditional finance theory, of behavioural finance? Okay, now the behavioural finance section, it's covered in more detail elsewhere. And I know this can always feel a bit strange where something's touched upon in one part of the curriculum, but actually belongs properly somewhere else. And my feel is always that things get examined properly where they are properly covered. So it's useful to understand a little bit about behavioural finance here, but if we're getting ourselves ready for the exam section on behavioural finance, it probably belongs in portfolio management. Okay, so talked about efficient. What does it mean? Well, it's defined properly here. Informational efficiency is what we are interested in, which means security prices quickly and fully reflect available information. So something comes out about the company, it's new information, no one knew it before, it's good. At the most basic level, the share price should quickly, almost instantaneously, move up to reflect the additional value. Let's say it's a new project they're doing, what's the expected net present value, and that should be incorporated into the increase in the market capitalization of the share. Which is great in theory, but in practice there are potentially things that get in the way of that. For example, that information getting out to everyone quickly, everyone being able to analyse it quickly, the ability of people to buy and sell shares on the back of that information. So we've always got to have a sort of a questioning mind with these theories as to whether they are realistic, and if they don't quite hold, where might they fall down? So if it were possible to get ahead of those price moves, that's where investors could earn abnormal returns, i.e. over and above the return that you expect for the risk that you are taking. And what we're saying is that if markets are efficient, that shouldn't really happen. So in terms of the official theory here, which was Farmer, whose name pops up in a few places, right at the turn of the decade 1970, when he came up with this theory, it was fairly straightforward. His language wasn't brilliant, I have to say, but we're stuck with it. But what we've got to understand is what information gets into a share price if the market is efficient. But he said actually it's not as simple as saying, is it efficient or not? There were levels or layers of efficiency. So if you've got a market that is weak form efficient, I always think of that as it'll get there, but it's slow. Now, Farmer didn't technically talk about how quickly information got in there, but it's a very good way of understanding what he was basically saying. So if you've got weak form efficiency, then the only information that is factored into a share price is the sort of past history of shares that have been bought and sold, past market data, prices and volumes. It's basically a way of saying that any newly released information about that company has not yet found its way into the share price. The market's just a bit slow. It will get there, but it's not there yet. So what does that mean from an investor's perspective? Well, if the market is the lowest level of efficiency, then there's no point in looking at charts. Charts show you the past record of share price movements and volumes and things, and that's already priced in. So what he's saying is that technical analysis, not to be confused with fundamental analysis, but technical analysis, or chartism as it's also known, doesn't tell you anything new. So there is, of course, a whole school of thought that says you can look at charts and see patterns. And until recently, that was in the curriculum, but it's not anymore. But basically, we don't think that you can decide that there are buying or selling signals from looking at charts if the market is weak form efficient. Move up a level of efficiency and you've got semi-strong efficient. So despite its kind of slightly strange name, that's probably where we think we are most of the time. So we're factoring all the past market data and information that has been made public, what the public knows about a company, that is factored into the share price. So this leads to a slightly uneasy conclusion, doesn't it? Which the only way that you can be ahead of the market is using information that the market doesn't yet know. And that's inside information. And that's pretty much illegal virtually all around the world. So if the market is semi-strong efficient, that layer up, then you can't consistently beat the market unless you're doing something which is probably dodgy, probably illegal. If the market is strong form efficient, then everything about the company is known. Information is leaky. It may have only been discussed in a boardroom, but somehow it's gone out there and investors know about it. So there is no way of consistently beating the market. So remember, when we talk about beating the market, we have to distinguish between a one-off lucky investment, which everyone could make, and consistent outperformance because you have superior knowledge or access to information or skills. Okay, so that's the most important thing, I think, is just understanding what is reflected in the share price at differing layers of efficiency. We then need to think which one of these maps to the particular market we're looking at. Now, we've also got a bit of terminology that we need to be confident with when we're talking about these things. So intrinsic value or fundamental value or the fair price is what something should be worth, bearing in mind the sort of, investors being rational and having access to full information. But that may not actually be the current share price. And if that is the case, that's where active investors jump in and say, right, that market value is below where it should be. So let's jump in and buy that share, or vice versa. Whereas passive investors, they're not looking for that mismatch. They're not looking for those pricing anomalies. They're just investing in shares because shares on average should give you a better return than bonds or cash. But they're not aiming to do better than the market. They're just tracking the market. And something that you might see discussed later on, just linking it, we talk about that excess return can be referred to as alpha, and just following the market is beta. You may see those terms come up when you look at portfolio management. And the thing that causes problems within the industry, and indeed certainly where I'm from in the UK, the regulators are really getting big on this at the moment, is that on average active funds underperform because they charge heavy fees. So on average, when you take the fees into account, active funds underperform the passive market. Okay, but of course an individual active fund manager may say that they outperform. Okay, but on average the sector underperforms because of the drag caused by fees. So investors need to know these things, don't they? It's all back to the regulation. These things need to be disclosed. So how do we test what Fama said? Are markets weak form efficient? Well, if they are, it shouldn't be possible to consistently beat the market by following pattern-based trading rules. And indeed, that seems to be the case. So as a baseline, evidence suggests that developed markets in particular are at least weak form efficient. Now, there may be some corners of the investable universe, other parts of the world that have not got such developed, liquid, regulated securities markets, where it may be possible to take advantage of markets not being weak form efficient. But most markets are deemed to be at least weak form efficient. What about the next level up, semi-strong? Well, if they are semi-strong, then share prices should move rationally in response to the release of new information. So on good news, the share price should rise, with the caveat that sometimes good news may be anticipated, so it may not come as a surprise. But if it does come as a surprise, the share price should move. And indeed, that's what we seem to see. And on the next slide, we'll have a look at what happened to Tesla over a period of time when some interesting stuff was going on that was affecting that company. So it does seem, again, that evidence suggests, not quite as strong as indicates, but suggests developed markets may be semi-strong efficient. But that's not quite such a strong statement. So there may well be corners of markets that are not. And that's where you can beat the market by listening, keeping an eye out, getting the new information and moving quicker than the market can. Strong form efficient. Well, if the market is strong form efficient, then remember that's the one where the share price incorporates everything, public or not. So even people with inside information would not be able to beat the market. And evidence is consistent with the markets not being that all-seeing, all-knowing. So, the evidence points towards developed markets probably being semi-strong efficient in general. So it's quite interesting tracking what happens to share prices when news comes out. Now, these are candlestick charts. Now, a candlestick chart follows some very simple rules. Obviously, it's share price per day. And when you've got a candlestick that looks like that, obviously it may not have a line through the middle. Sometimes it does. What you've got is the share price having risen during the day. So the bottom of the block is the opening share price. The top of the block is the closing share price. The top of the sticky bit is the maximum and the bottom is obviously the minimum. So that's a day where you've had the share price rising. If you've had the share price falling, it's a coloured in one. So this time your opening share price was higher than your closing share price, but obviously the maximum and minimum are still the same. So it gives you quite a nice visual as to what's happened during the day. So you've got a big movement that comes out and whether the share price has risen or fallen. And so this is quite interesting to watch. So the first point that's noted here with Tesla is that after the market closes, there is basically a good news story. And that's why there's a jump. You can see that jump from the 1st to the 2nd of August, reflecting when the market opens again, the new share price settles higher. Okay, then the next day, Musk says he wants to take the company private. This is not public information at that point. Okay, however, the share price on that day does seem to rise. We're just wondering about that. Is that some information leaked? Or is that just something else that's going on? That's part of the 2nd of August, reaction to the good news. 7th of August, another good news share price day. That's that infamous tweet where Musk says funding secured. And obviously that ended up going through the law courts. Interesting if you're not aware of that. Interesting to have a bit of a Google what went on there. Anyway, the market obviously reacted quite a lot to that as well. So that was another good news story. And then we see a sort of constant decline from that point onwards. So what was going on there? Did people not necessarily believe him? Was there a bit of a question mark over that? Because 420 was the price and the share price never quite got up to that. But it seems that we've got a sort of constant dribble of, maybe disbelief. And on the 24th of August, where the share price hardly moves at all, he no longer intends on taking Tesla private. So had the market anticipated that, and it got essentially pretty much back to where it started. But we definitely see some things in there where news came out and it clearly moved the market. But there's also just a debate as to what is news and what is anticipation. But if it's generally something new and it moves the market, then we can usually see that happening. Okay, so moving on, we've got pricing anomalies. Pricing anomalies means, pharma, 1970, we said the markets, or had evidence that the market seemed to be efficient at various levels. However, there are some things that don't seem to fit within that framework. So this is a discussion which might be slightly frustrating to those of you who maybe come from a more sort of scientific background, perhaps. Like myself, I did a physics degree, and I found these things slightly strange, where we talk around things and say they may have an impact or they may not, or they may be used to, but now we think they don't. And sometimes we've just got to shake off that physics envy that comes with finance and say we need to discuss things. And there isn't maybe an answer yet. There may be things that have been observed once or twice, perhaps there's a reason for them. Maybe they weren't observed again, but it's still worth discussing. And sometimes these mispricings are observed initially and then the market cottons on to that certain types of companies or at certain times of the day even. Share prices have this sort of inclination to move, so the market reacts to that, and that in itself stops it happening. So time series is really when you're looking at the change of price over time and seeing if anything is happening that's outside of the efficient idea as to things being priced quickly and rationally. So anything that refers to weeks and months, maybe even days, is probably going to sit within a calendar time series anomaly. So old things like buy in May and go away, was it? Oh no, sell in May and go away. The idea that share prices often drop over summer or rise over summer. Well, whichever one it was or is, if everyone else piled in and started following that advice, you probably wouldn't be able to make any money out of it anymore. Or is there a chance that you buy on a Monday, sell on a Friday and keep doing that? Are you going to consistently make money? Well, maybe you could at one point. But now again, if everyone's cottoned onto it, that would be ironed out of the pricing. Momentum is really just the fact that often trends persist for quite a long period of time. So if you see a share price rising, well, maybe it's time to buy it and sort of follow what everyone else is doing. And that may work for a while, but then probably there may be a bubble and the bubble may burst and everyone ends up getting hurt. Or overreaction. So prices may swing too high on good news and swing too low on bad news. Again, it's moving away over time from what should be observed in efficient markets. Cross-sectional is looking at prices across different things. So we're not looking at the passage of time, we're looking at comparing across, for example, big and small companies. So it may be observed that if you buy shares in small companies, you get a higher return. It may have been observed in a study and then it didn't happen anymore. And that's really the discussion around size. Value, well, there's always a debate. Should you invest in underpriced companies or should you invest in companies that are going to grow? And they're often the opposite companies. But there had been an observed fact that investing in value companies, so those with high earnings yield or low price to book ratios, for example, seem to outperform. But another bit of finance theory popped up where CAPM was expanded to say, again, you may not have done CAPM yet, but the capital asset pricing model was expanded to take account of this, and then it no longer seemed to be an additional return. In fact, it was priced into the risk you were taking. So the models may have just missed something, or indeed with the size, it may have just been a one-off observation, or not, as it says at the beginning. So we need to look at these things and just be aware of potential opportunities to find outperformance. And other things that maybe just don't follow the rules. So closed-ended investment funds, so collective investment schemes trading at less than what the underlying stocks that they invest in are worth, which might be down to the fees, or again, it might be a pricing anomaly. IPO pricing, I remember the first dot-com boom and subsequent times, it seemed that every time a new IPO, a new company came to market, you bought in at the start and you were almost guaranteed an immediate gain. And I always felt that's wrong. That's breaking the rules of risk and return somewhere. Where's the risk there? Now, recent IPOs have not factored in a gain. In fact, it's been more likely that you've ended up losing money. So maybe the risk was just, perhaps it hadn't come into the system properly. And earnings surprises is that it kind of goes against overreaction, but it's very specific. So with an earnings surprise, it's where a company maybe releases their quarterly update and their profit is higher than was expected. Now, it should be that the share price moves instantly and rationally, but what studies have shown is perhaps there's a bit of a drag. It doesn't get where it should do quickly enough. So in theory, well, not in theory, but in practice, what they're saying is that if you were watching out for companies that had better than expected earnings, better than expected results, and you bought those shares, there was still a bit of up movement to happen because the share price adjustment wasn't instantaneous and rational. So you could kind of get in on that bandwagon. Again, this may be something that if everyone does it, then the anomaly disappears. So be aware of what these things are. I think sometimes there's a risk of trying to rote learn lists of things. So what I'm trying to get at is why these things might be observed prices that are not quite fitting in with what the efficient market suggests. And behavioural biases, as I said, you've got a whole section on this to come, but it's the very sensible observation that followed this kind of hot decade of finance theory, the kind of 60s into the 70s, where everyone was treated as rational economic beings, all making the right decisions quickly and rationally. And then psychologists basically came in and said, well, we're people and people are flawed and people don't act rationally. For example, one of the central tenets of things like capital asset pricing model, efficient market hypothesis, is that investors are risk averse. Now, that doesn't mean we run away from risk. It just means we need it rewarded. So things that are more volatile, we need to expect a higher, longer term return, albeit it'll be a bumpier road. And it's like having more fun on a bumpier roller coaster, but there will be ups and downs involved and there is risk. So loss aversion is saying actually we're not risk averse. Risk is about volatility, standard deviation. And to be honest, the average person doesn't really get that. But what they do understand is losing money. So it's taking the maths behind the models and saying, actually, we're worried about downside. We're not so worried about having fun and the upside and doubling our money, but we really hate it when we lose. And that can lead to different decision making. Okay, again, let's leave the detail for where the detail exists. Let's just understand that it means that perhaps our models are not quite right. Anything that looks at risk and return perhaps hasn't got it right. Instead, we get very worried when we start losing money. We also don't like blaming ourselves for our mistakes. We like to group together, we herd together, and then it becomes less about our decisions and kind of, well, I'm just following the market. So you tend to get herding behaviour, which again can exacerbate price anomalies. Everyone can pile into something which makes the price go up, but actually has no fundamental basis. We're following what everyone else is doing. And that's fine for as long as it lasts, and then it can lead to a sort of a reversal, a crash. Or overconfidence, just our decision-making process is not rational. We think we're always above average drivers, for example, but we can't all be. So overconfidence again. Now that might be more of an individual thing, which maybe doesn't move a market, but it can again lead to prices not being where they should be. And information cascades, that's really about how in reality information maybe starts it gets fed to perhaps the analysts, and there may be some superstar analysts who everyone follows, and then that information gets cascaded down to the rest of the market. Now, that might be a good way of passing information around, or it might mean that we all become imitation traders and basically do what the analyst tells us that we should do. So that, again, could be a form of herding, really, couldn't it? So that's really just where we end it. So it's kind of note of reality. So the module is about understanding the efficient market hypothesis, but also being a critical observer of it and saying there are reasons why prices may not always move quickly and rationally. And that's where we end that module masterclass.